The inflation discussion is hard to avoid these days, with the cost of living crisis taking up considerable space in print media. The consensus opinion is moving towards the expectation that inflation will settle back later this year, but at a higher level than we've become used to in the last generation. Now, you add to the mix the persistence of negative interest rates on deposit, and you have a very painful recipe for savers: deeply negative real returns on so-called risk-free investments. So what is the outlook for inflation? Well, financial markets are not fretting, as futures markets seem to indicate a willingness on the part of investors to believe that central banks have the situation under control, as judged by inflation futures, which predict average inflation in the US of just 2.5% over the next 5 years. Given inflation currently running in the US at just over 9%, that suggests quite a steep climb down over the next 12 to 18 months. Now, we hope for a benign scenario where inflation returns to modest levels, but we should plan with humility, recognising that the future is inherently unknowable. So when we think about inflation, I mean, at its most basic level, it's like a tax. It depletes our spending power. Unlike a tax, however, its impact is not as explicit. We don't get reports from the bank quoting our balance in real after-inflation value terms, i.e. what it's worth today versus a year ago. Everything is quoted in nominal price terms. So this is not a helpful way to conceive of money. In the long run, the only rational definition of money is purchasing power. And money is a means to an end, and that end is its ability to fund our spending habits. If our money is being eroded by 5% inflation a year, we will lose roughly 40% of our spending power every decade. So we should therefore make investment decisions in consideration of this risk. Now, many investors will never have experienced inflation like we have seen in the last few months, so it may be a good time to revisit what that means for investing. And equities over the long term have provided strong real returns, so after inflation. If your metric for how much risk you take on is maintaining that purchasing power, then the stock market, alongside property and other real assets, has proven to be an important generator and protector of real wealth. But the impulse to protect what we have is instinctive to us all. So what's that got to do with inflation and negative interest rates? Well, if my living costs double and my capital and interest thereon remain the same, I've effectively lost half of my money. Now, that should trigger alarm bells for the risk averse, but we tend not to think about inflation risk in the same way as we do about the risk of capital loss associated with stock market volatility. And my thesis on this is that we're concerned about the risks of doing something, making an investment decision, but not concerned about the risks of doing nothing, decisions we don't make, i.e. defaulting to leave the money in cash. So that decision-making flaw has the potential for greater wealth destruction than the stock market does. So the default decision to do nothing has never extracted an explicit cost, but now we have negative interest rates. It has always extracted an implicit cost in terms of foregone opportunities, but given the extremes of current inflation, the price of inaction has gone up. There's a cost to investing, and there's a cost if you don't, but take control and make a decision, and you'll have a better chance of minimizing that cost. If you'd like more information, please contact your advisor.